Welcome, everyone, to the Leaders in Housing Counseling call. Glad to have you on today. Our, uh, our, our episode for August. We won't do a second one, so this is the only one in August. We'll give you a break and get back in the swing of things in September. But welcome to the call, and I think we've got a full agenda today, so we're going to get right into it. And we've had a lot of activity on the NHRC policy world in Congress and in the House and Senate. Melody's been very, very busy, so we're going to walk through that. We have two pretty interesting presentations coming up. One on using EITC to develop home ownership opportunities, and the other one on an agency-run down payment assistance program. Both of these fit into our innovations in housing counseling program and really make us help us understand create the opportunities for diversifying our business and creating new income streams, but still serving our clients. And so I think these will both be useful sessions on today's call. We'll do a quick reminder on NHRC membership, and our next call, as I mentioned earlier, will be in September. We won't do a second one in August. So with that quick note, we do have some news, which is NHRC has turned 7 years old. And, you know, it's been quite a ride, and deeply appreciate what everybody's been doing out there. We have gotten to be a bigger, more valuable organization, deeply involved with many of the issues that you're doing in your localities, all the way up to the halls of Congress. And we're really become a vehicle to think through how to tackle some of our biggest and most important issues, including what's happening with certification, how to pay for the work that we do, how do we grow, how do we increase our public visibility. There's just a broad range of things we're deeply involved with, and it's really because many of you have all jumped in with both feet and contributed. I know you have a busy schedule, and we really appreciate the contributions that people make. I'll send out an email later in the month about this and do a kind of a little bit of a summary of where we're at, state of the NHRC union or something. But, you know, first just wanted to share the goodwill with everybody. So with that quick note, let's go to what's happening in the halls of the House and Senate. Melody.
Thank you, Bruce. Hello, everyone. It's been a very, very busy couple of weeks in Congress. So I'm going to do things a little bit differently and sort of break up all the topics of conversation around policy and congressional and administrative affairs for you all today. So with the congressional budget caps deal, a little bit of background. NHRC has been very, very busy on fiscal year 2020 appropriations. I'm sure many of you saw our outgoing emails discussing our efforts with the House T-HUD bill and working closely with the Senate. In our conversations with the Senate, we were told time and time again that the Senate Appropriations Committee was not going to move forward on any discussions on fiscal year 2020 until they addressed the budget caps deal. Today is the vote for the budget caps deal. It was scheduled with the Senate. If there was an update, I'll definitely let everyone know following this call. But they were expected today to vote on legislation to avoid the $125 billion discretionary spending cut, and as well as to increase the debt ceiling through 2021. I'm pretty optimistic they reach the deal on this. If they do not, then we should expect many programs, including the housing counseling program, to be drastically cut. I believe it's 9% for non-defense discretionary funding. So I'm really happy about this deal. It was between House and Senate leadership as well as the White House. Oops, forgive me for that. Yes. And so following the budget caps deal, the Senate is now moving forward again with their fiscal year 2020 appropriations. The chairman of the Senate Appropriations Committee, Senator Shelby, this week is finalizing allocations for the funding bills, including THUD. However, we don't know or may not know what the final dollar allocations will be for each of the 12 funding bills, including THUD, until potentially September, when the committee schedules its first markup. We heard it's potentially September 12th, but that's just speculation. No one is certain. And they're hoping that they can get everything done by the start of the new fiscal year, which is October 1st. In the event that they cannot, a short-term CR is very likely, a continuing resolution until Congress finalizes a budget. But the downside of this is that due to the budget deal, the figures in the House THUD funding bill, which was $60 million for housing counseling, may be revisited. The House moved forward on, as we know, funding levels for different programs, and $60 million is what the House THUD subcommittee bipartisanly supported. But because the allocations to the Senate will likely be much lower than the House, the allocations the House was hoping for. This means that funding for the housing counseling program, when they go into conference, may remain at fiscal year 2019 levels, which was $5 million, or it could be cut even further. We have no way of knowing. We've had conversations with Chairman Price's office. Chairman Price is the chairman of House Appropriations THUD, and that was the information that we got, that things may or may not be revisited. They may have to cut during conference. We're just not sure. Everyone's kind of just waiting to see how the Senate responds and then follow accordingly. But because everything seems to be very much in the air, this makes advocacy between now and the September Senate markup more critical than ever. We have to make sure that we're continuing to really push the Senate, and particularly Senate Republicans on the Appropriations Committee, to really protect and champion housing counseling. And this is where all of you on the phone will definitely be able to help us. In March, NHRC circulated a national sign-on letter asking both the House and the Senate to increase funding for the housing counseling program at $65 million. We were really successful in our advocacy with the House, and they increased funding for fiscal year 2020 to $60 million. So NHRC will circulate an additional sign-on letter specifically to the Senate Appropriations Committee, asking them to fund the program at $60 million for 2020, matching the House THUD recommendation. The link is on the screen, as you can see. If you haven't already, please sign it, as well as circulate the link to your partners and contacts in the industry. We're hoping that we can surpass 300 signatures, which is what we had for our previous sign-on letter. But we hope to submit this to the Senate by the end of this month, prior to them returning to Congress. Right now they're in August recess. We're hoping to use this opportunity during recess to talk about the funding level, as well as to discuss the sign-on letter and so forth. So please sign on to it if you haven't already. Moving on from appropriations, we've been very busy working on legislation that we hope will help the housing counseling industry, aside from just funding. And one of those was the Community Development Block Grant Disaster Recovery, such a mouthful, legislation. This legislation would permanently authorize the disaster recovery bill. And we were hoping that we would try to include housing counseling specific language in the legislation. And we're working really closely with both chambers on this. But just this week, last week, S-2301, sponsored by Senator Schatz and Senator Young, was introduced in the Senate Banking Committee. Their legislation goes a little bit farther than the House bill, but we're hoping to work with both their offices on including housing counseling language during the amendment process. The House bill, H.R. 3702, which was sponsored by Representative Green from Texas and Representative Ann Wagner from Missouri, passed the Financial Services Committee, and it will go to the floor of the House, we're hoping, in the next couple of weeks following August recess. What we're really excited about with this bill was that it was passed unanimously, and it was bipartisanly supported, which is very, very rare. So there's a lot of energy around this legislation. We like that it's supported by both parties, and we hope we can try to include some housing counseling language in it, leveraging this bipartisan success. And finally, on legislation, the Housing Financial Security Act. This is a bill that provides a 25-point discount for FHA mortgage insurance premiums for first-time home buyers if they finish a housing counseling program. The bill was originally sponsored by Representative Beatty and Stivers from Ohio, and this bill passed the House, H.R. 2162. A Senate sponsor for the bill was found, but their office is currently seeking original Republican co-sponsors, preferably on the Senate Banking Committee. So working really closely with their office to find original co-sponsors. If anyone on the call would like to assist us on that effort or learn more about the legislation, please just reach out to me following the end of this call. And I believe that's everything I have on my end. If you have questions on the legislation or the appropriations, please submit your question in the chat feature, and I will try to address that at the end of our presentation.
Excellent, and thanks for the good work. Please, we really need to get the numbers in on the sign-on letter, especially important that we get groups signing on states that have Republican appropriations members in the Senate. That's where the biggest push will be and where the biggest need is. So, you know, if you're in West Virginia, if you're in North Dakota, if you're in Arkansas, if you're in Alabama, all those states very valuable to, I'm leaving some out, but all very valuable to have a strong showing there. Maine is very important. I mean, the Maine groups have been terrific so far, so let's make sure we have a really strong turnout there. But we need everybody. We need the whole country to be well represented. This is what kind of makes the political wheels turn on things like this. Okay, with that good note, let's move on, and let me turn it over to Ellie.
Thanks, Bruce. Hi, everybody. So today we're going to hear from a couple of organizations that are working to really help bolster people's wealth. And one of the ways, of course, is the American dream to become a homeowner. That is a big way that people have been able to be boosted into a higher wealth bracket. So we're going to hear first from Sadie Johnson-Sandlin with the Famicos Foundation in Ohio. She's the programs and services managers there, and she's going to explain how they're helping their clients use earned income tax credit funds as a foundation to gain access to credit and build wealth. Sadie.
Good morning, everyone. All right, wait, good afternoon. I'm in the wrong time of day. Business is busy. We can continue on into the next slide. It is my absolute pleasure to share this remarkable organization with you all. I am, as was mentioned, Sadie Sandlin, Programs and Services Manager here at Famicos Foundation. We can carry on, please. Okay. Our nonprofit organization was created out of civil unrest and through screams of inequality, which led to a pivotal event here in Cleveland, Ohio, which is known as the Huff Riots. With this event entered our founder, Sister Henrietta Goris, and so began the Famicos Foundation, and this is our mission. And next slide, please. Thank you. Okay, here. From our faith-based roots, our volunteer spirits prevail. As an affordable housing provider, we manage a lease purchase program, helping residents move from renting to home ownership through housing counseling and its various asset and wealth building components. Next slide, please. Here under the community services note umbrella, you'll note that the vehicles we use to assist in building wealth are the educational tools of the free tax preparation and the financial coaching, which I will be discussing briefly with you all today. See, nothing there. Okay, next slide, please. Thank you. All right, in our focus on financial integration, as it is my understanding that you all are looking towards some of this, With Amigos Foundation, in collaboration with our local enterprise community partners, Amigos Foundation serves as a partner site for the Cuyahoga County EITC Coalition. We provide free tax preparation assistance, which is helping community members from the greater Cleveland areas and beyond learn to navigate tax and its advantages from the employment level with the W-4 allowances through quarterly self-employment tax and into retirement. The funding is layered, both public and private. And it lists as one of the partners in there is, of course, the IRS, who provides for the training, site materials, and required postings. Okay, and then there's also a preparation software. We'll talk about those a little bit more as well when we talk about funding. Partner sites, as a partner site, you will provide the location for the preparation and all of the on-site support. So, of course, that's going to impact how you're already utilizing your location. The coalition overall provides the preparers through channels suggested by the partners and from a pool of any returning volunteers, which are generally made up out of or of a body of college students, any alumni, professors, there are actual accountants, retirees, and community members. Our financial coaching segment is an additional collaboration with funding through our Cleveland Neighborhood Progress and in partnership with community financial centers. Both our affordable housing residents and our tax clients receive financial coaching services at local north, south, east, and west Cleveland locations, providing services in personal financial goals, managing and reducing debt, improving and building credit, customized banking tools and the services that banks offer, planning and managing retirement, which also makes them a great asset to the coalition and the families that we service here at Amigos Foundation. Next slide, please. Thank you. All right. So this is a brief visual review of partners and some funders. As previously mentioned, funders are usually layered with both private funding, and the private funders are usually in the background, of course. So here are just a few of those in the spotlight. And if the coalition turns out to be something that you're interested in, please be free to invoke my referral to Kathy Matthews. She will welcome your call. As it relates to funders themselves in this thing, funding usually is going to tap into, as I mentioned, what you're generally doing from day to day anyhow. So it impacts your bills because you're running the site on site. It impacts your payroll because your people who are on site that are expected to run the site will be working those additional hours. And of course, it will impact your administration fund or your administrative funding. So those are some avenues that you're going to want to look to bulk up or bolster a little bit when you are looking at your funder and what it's going to take to run these sorts of programs. I'm going to go to the next one. I know we don't have a lot of time. Thank you. Okay. As with anything aiming toward critical mass, when you first began is the work which consistently revisits the drawing board. There is no recreating of the wheel, just people finding more innovative ways to get the work done, as we all know. Okay, so absolutely you want to, because it requires building partnerships to expand your location, so research your key partners. Find out what's their buy-in and how can they help you. Most funders are there to help you. As it relates to familiarizing your branding, you want to pretty much saturate their curiosity, get to know, help them to get to know who you are. The old saying, people don't care how much you know till they know how much you care. Get out there, become a familiar slogan where everyone knows your name. Neighborhood, know what your challenges are when you're trying to get people to come to your site to partake of these services. We were just a few neighborhood buildings until we had something to offer. So be aware of what could keep them aware. Do you have accessibility? What's the stigma on the neighborhood? And is there truly a need? As it relates to capacity, provides results. Lord have mercy. When I first came here, the program was in its 3rd or 4th year, and here at our site, we were preparing numbers in about 500 to 800 returns each regular tax season. I'm going to have you go to the next slide. Thank you very much. And so now, here we are several years later, and those numbers have bulked up apparently. The marketing has increased, especially with the expansion with the 2 programs. Marketing is now in local kiosks. We are on the bus. We are on the buses here. We're definitely in the media. Never underestimate good old-fashioned flyering to any of the locations you can. And we even have magnets, which people can use year-round. So we're always in their face, so to speak. Branding is now being marketed in multiple languages, because once you reach out to those different markets and people partake of the program, then you are addressing different people from different backgrounds and different countries. Neighborhood, how do you get people into your neighborhood? You will visit the refundohio.org website, I apologize, and you will learn about things like Super Saturday, where we do Senior Day or Banking Day, things like that, to bring not only your people in, but also services or providers, tax preparation from providers in the local area. And so as it relates to capacity, we have truly grown. We are now a year-round site, and we prepare up to a total of 3,000 returns, both federal and state combined. And as you can see in the results on the screen across the coalition, this year's numbers are in, and these are what you see in front of you, that 12,232 returns that were filed across the greater Cleveland area, and refunds totaling beyond $17 million. So it's an excellent opportunity. The accountants on your staff, if you have comptrollers, they will know, they will be able to access it. Now, it's not a big money maker for you as an organization, but it is a way to serve your community, and it is a way to bolster some of the services you can provide to those who are partaking of your housing counseling services. Thank you.
Well, thanks, Sadie. That's great. Our next presenter is Kelly Almanzar from the Housing Development Fund in Connecticut. He's the Director of Residential Lending there. He's going to tell us about a down payment assistance program that they developed in response to the lack of affordable homes, even for those with middle incomes. Kelly.
Good afternoon, Ellie. Thank you so much, Sadie. It looks like you've done wonderful work. It's going to be very difficult to follow you, but I will do my best. As Ellie said, I'm the Director of Residential Lending here at Housing Development Fund. My goal today is to tell you a little bit about who we are, the impact that we've had in the communities that we serve, and how we were able to have that impact on our community. So if we'll move to the next slide, I'll start that presentation. So we're actually celebrating our 30th anniversary this year. We are the CDFI, and I'll read through our mission statement because I think it's important, which is HCF's mission is to facilitate the development of affordable rental and home ownership opportunities. HCF accomplishes this mission through assisting households in becoming and remaining owners of affordable homes, and through the formation of limited partnerships which expand affordable rental opportunities for low and moderate income housings. The reason I read out the mission statement because one of the models that we have here at the organization is that one of our focuses is to make successful homeowners, not just to get people in homes. We saw that, I think, 10 years ago, 15 years ago, when the market had kind of really focused on just getting people into homes and not really caring about whether they can stay in their homes. So certainly that's near and dear to me, that philosophy. We are a HUD certified counseling agency, so we do provide counseling services here. We've expanded over the last 30 years. We started here in Connecticut in the lower Fairfield County originally. We have 3 offices now in Connecticut, one in Stamford, one in Danbury, one in Bridgeport. We have expanded our operations out to New York, Massachusetts, Vermont, and soon we'll be licensed in New Jersey as well. So we've had an impact here in the Connecticut community. So what we've done is replicated that model in other places, and we've been successful with it. If we can move on to the next slide. So this is the slide I call my brag slide, and I'm really proud to talk about this slide because this is where I have the opportunity to talk about the impact that we've had on the community. And the numbers I really love to highlight here is if you look on the third item down, which is the first-time homebuyers item here, almost 3,000, we're getting close to 3,000 homeowners that we've been able to help. The next line item there is Smart Move, and we'll talk about that product, and that's the product that we've been able to use to help most of those people. But some of the numbers here are absolutely staggering. So if you look at $82 million in Smart Move loans closed. Another number that I'm extremely proud of is that $419 million number of first mortgages. So those are numbers, first mortgages that we've been able to use to leverage in conjunction with our down payment assistance program. So clearly, these are some large numbers, and we can see that we've been able to help a vast majority of people. We'll move on to the next slide. So I'll talk a little bit about, hopefully I've given you a little bit of an idea of who we are, the impact that we've had in our communities. But now let's talk about a little bit of how we've had that impact. And let's talk about Smart Move, which is our premier product for down payment assistance. And let's start with the conversation with why we started with why we developed the Smart Move program. Here in Connecticut, the numbers for renters, their average income, the income that's allocated or they use towards their rental housing here in Connecticut is around 33 to 35%. So that causes a challenge because we ended up seeing a lot of borrowers where everything else was right with this borrower. They had the credit qualifications, they had the income qualifications, they had the work history, they had everything else, but the difficulty they had was obtaining the down payment. And it's not hard to determine that when you think about that the average person here in Connecticut is using 35% of their income towards housing costs or in rental costs, because then you really don't have the ability to save. So what we came up with is this product, the Smart Move product, which allows 100% financing. So it takes away that one of those major obstacles from a borrower standpoint in terms of if you've done everything else right, if you've been able to maintain your credit, if you've kept employment, if you kept derogatories off of your credit report, and the only obstacle you really had is being able to save up for a down payment, this is your solution for you. So what is Smart Move? Smart Move is a down payment assistance loan that provides up to 20% down payment assistance. It is used in conjunction with a first mortgage at 80%. So hence why I said it's 100% financing. We have a network of partner banks here that we work with that provide the first mortgage. In fact, we have 18 banks here in Connecticut that have the ability to provide a first mortgage in conjunction with our down payment assistance program. Now, I'll talk a little bit more about the mechanism of it, but the really unique thing about it is that 20% loan that we give out is actually capitalized by our partner banks. So those 18 banks that I said are able to offer the first mortgage in conjunction with our debt program, they are the ones that actually capitalize the 20% down payment program. So it's very unique in that sense that we don't look for outside sources from government agencies to fund the source. We've actually found a method here in Connecticut to be able to get banks to participate in this program. We'll move on to the next slide, please. So what the Smart Move loan is, it's, if anyone has any experience in the mortgage market, it's a lot of the 80-20 that we would have seen 10, 15 years ago. The difference with it here is that it's discounted on the interest rate. It's a 3% 20-year amortizing mortgage. The closing fees on it are anywhere from $750 to $2,500, and that's on an origination cost basis. But once again, it provides up to 100% financing for those potential borrowers. Now, the caveat to that is that all our programs are income-based. So I always use this phrase here called the Goldilocks zone. And what I mean by that is that clearly we want to make sure that people qualify because there's going to be a repayment on this loan and there's going to be a repayment on the first mortgage, but there's an income cap on it, so they can't be over income. They have to be low to moderate income buyers, and we use the FFIC income limits here for that. So enough income to qualify, but not over income where you're not qualified as a low to moderate income buyer is the goal. Borrowers that will obviously the other thing going along with that is that they are first-time home buyers. If we move on to the next slide, you'll actually see there those are our income limits. In our Connecticut area, and this is just for example, like I said, we're in other states, but here for Connecticut, and let's use Fairfield County as an example. So as long as the household income is under $111,000, and that income will qualify for the repayment, you are a first-time home buyer, and you hit the other buckets, and we'll talk about the other buckets from a standpoint of eligibility. to qualify for this program. Let's move on to the next slide. So these are our banks that participate in the program. You'll actually see that we're listed there, Housing Development Fund on the first column. So we have, to put it this way, we put our money where our mouth is. So we actually participate with this program. Each loan that goes out, service that loan. So if there's repayments on it, we take the payments on it and we divvy those repayments to all the other capitalizers of the pool. But we also share in delinquencies, and that's just a reality of the mortgage market and in the world that we work in, that there are always going to be some people that things happen, unemployment, health issues, and people get behind payments. So we also share in the delinquencies as our partners do. So we have a very vested interest in working with and building up borrowers to be very successful borrowers. I'm going to stay on this slide for a second just to talk about it a little bit more. So you can see we have a lot of banks here that are participating with us. And I'm sure one of the questions that probably pop into mind is, why do these banks participate in the program? Why do they take their funds, capitalize this pool, which is about $14 million here in the state of Connecticut right now, for down payment assistance? And the answer is easy in a couple of respects. One, we like to think that it's a good product and they want to have access to it. The only way you have access to the program is by being a capitalizer to it. So it gives them another product, another avenue that they have for down payment assistance. The second need from a bank perspective is banks have a CRA need. All these loans qualify for them on their book as a CRA investment or credit. So that's another reason why they participate in the program. The third one we like to say is that we deal with, and going back to one of the first statements I said, is that we really want to create successful home buyers. So if you remember on the last slide, we talked about that it's a 3% interest rate. So we'd like to believe that we have, well, not like to believe, but we have a very low delinquency rate. So in that sense, that it's a good bet, I would say, for the banks in terms of it fulfills some of their needs from a CRA standpoint. It gives them access to another product. And at the end of the day, there's actually some money to be made from it from their standpoint, because we deal with a very low delinquency rate, which is staggering considering the fact that most of the transactions we do have little if no equity in them, because we're doing up to 100% financing. But yet our delinquency rate right now runs under 3%. We like to think that the reason for that is because we do a very good job of counseling and getting these borrowers to once again be successful home buyers, so that they understand the expenses and everything that's involved with becoming a first-time home buyer. So these banks are all our participating lenders at this point. These are the only banks that can provide the 80% first mortgage in conjunction with our DAP loan. Let's move on to the next slide. So we are lenders at the end of the day, at least in my department. We do various things here at the organization. We do counseling. We have a multifamily division. But for me and my division here, which is residential lending, we are traditional lenders in that standpoint. So you'll see here in terms of, we look at everything just like any other lender would be looking at in terms of employment and income history, assets, debt, credit history, and property appraisal. So just as any other bank would underwrite a loan, we do the same thing with our down payment assistance. And underwriting at the end of the day is just kind of mitigating what the risk is on something and being able to qualify that. And that's exactly what we do. Once again, we want to make sure that these people stay in homes. We don't want to put them in a position that they can't afford their payments. I would certainly say that we are much more conservative in our underwriting versus some of the main industry at broad range at this point. But once again, it kind of goes in line with what our mission statement is, to be able to create successful first-time home buyers. I'll talk about some of those income qualifications on the next slide. Okay, so it is only for first-time home buyers, and by definition, that would be our HUD regulation, which is 3 years removed from home ownership. They are required to have a 1% borrower contribution into the property. Now that can be part of their closing costs, but as long as they have 1% within that transaction, we can work with that customer. And the reason for that is that there's just a lot of data out there that shows the difference on a delinquency standpoint in terms of when someone has zero investment in a property, and even many of you may not think that 1% is a lot of investment, but even that 1% makes a huge difference in delinquency in terms of people just having skin in the game, basically. All our products require housing counseling, so they require home education. We work with people who are U.S. citizens, permanent non-residents, and have certain visa qualifications. And then we'll just go over some of the things here in terms of, we do accept non-traditional credit. We don't do anything automated today, so we're not like a big bank where we're underwriting and it's a system spitting out an approval, eligible or ineligible. we have actually a loan committee here that actually goes through the loans and has questions on it sometimes, and there's a human element to it, to understanding why there was a delinquency, why there may be payment shock in this case. So we always like to say that there's a very, even though we're working the mortgages and we are lenders in essence, there's a very human element into what we do, because we have a loan committee that actually can look at and give exceptions to files based on what the whole story of that borrower is. I have a couple of some bullet points here that I wanted to address here that Ellie had sent to me, and one of them was, how did we feel that this helped our community? And it goes back to my first point. One of the things that we look to do here is to overcome all the obstacles that are out there to keeping people away from home ownership. And one of those things that we identified was that just the ability to save, not being able to either come up with a down payment, even on the FHA at 3.5%, and not having to have the responsibility or the of let's say the FHA mortgage, where you have mortgage insurance here. So if you've been paying attention, you see here the structure of this loan doesn't allow or doesn't have the necessitate the need for mortgage insurance. So what we were trying to do, and the purpose of creating it, and the goal that we were trying to fulfill within our community, was to keep costs down for those borrowers as low as possible by avoiding mortgage insurance, and helping them in the sense that they don't have to have all the money for down payment, that they have services such as our product that would allow them to be able to come up with the down payment and achieve that goal of home ownership. So with that said, I think, is there another slide, or the next one is Q&A, I think with that said, I wrapped up my portion of it.
Well, thanks, Kelly. I do have one question that I would like you to talk about, and that's related to what, you're doing a lot of work around the funding and eligibility requirement, and what funding ends up coming back into the organization as a result of all that work that you're doing.
Okay, very good question. So as you saw in one of the slides, there is an origination fee on it. So anywhere from, it's tiered based on loan amount, so it's anywhere from $750 to $2,500. So there's the origination fee, and there is an interest component to it. So what comes back into the organization from a fee income standpoint would be the origination fee and the interest as we're repaid and remittances on the loans.
And do you find that helps to cover the cost of your housing counseling that is required for this program?
I'll be very frank with it. The mortgage business is very expensive to do. From a compliance standpoint, from a standpoint that you need to have certain professionals, you need to have qualified underwriters, you need to have qualified processors on it. As a standalone, from just a residential standpoint, my division itself, we're not self-sufficient. We're able to do the business that we do because we can kind of fill some of the donut hole with grant funding. As a self-sustainability, if we could only do business based on the production and the income that it generates, it would not cover the cost. So the way it's structured right now, we can cover some of the costs. I think we're about at 60% of the cost is covered by the fee income that we generate, and the rest of the income expense on it is covered from grants and other sources of income within the organization.
So let me just jump in with a kind of follow-up question on all that. So you charge a 3% rate
interest
on
rate
on the down payment
correct
loan. But your cost of money could be greater than that, right?
We don't pay a cost of money on it because the only thing that we pay on that fee is a servicing fee to our servicer, which is about 50 basis points. Other than that, the bank partners that capitalize that pool do not have, like I say, they participate more for the CRA need, so we don't have a cost of funds on those monies.
That's vital to understand. I think that is a driving force. It's very helpful. And the fact that
Absolutely.
you've got as many lenders as possible to do that, as you've got on your list, that means it's quite doable.
Mm-hmm.
Interesting.
That's a great question, Bruce. Any other questions?
So I don't have any specific questions for you, Kelly. Sadie, I did want to have you kind of revisit a little bit. You talked about the importance of being at the table with different partners so that, you kind of get your name out there and so on. And you mentioned the work that you're doing is more about providing the service to your community. So I'm kind of asking the same thing of you that I asked of Kelly around what you know, the work that you're doing with the Earned Income Tax Credit and the VITA sites and all of your partners, do you see that there's any way that it brings funds into your organization?
Well, from my perspective, and I'm not the asset manager, so don't take me on my, like, I'm not the say on this, but what I understand is as long as we can present that the services that we are providing is providing that payback to the community and giving the other partners, and that's the thing about the layered funding, is there are other entities at the table, like the Cuyahoga County, et cetera, et cetera. There's their buy-in and how it benefits them to be able to assist us in providing those services to the community or to the members in the community. Ergo, we have an avenue or a vehicle that we can return to that funder, or if that capacity grows, and when that capacity grows, then the funding has to grow as well.
I think some
This
groups...
is Melody. Excuse me. This is Melody. Question came in. So is the DAP funded by the lending partner?
Wait, is that Michael? No, that's his question.
I think that's for Kelly.
Yeah.
The down payment assistance.
Can you repeat the question, please?
Forgive me, Kelly. The question was, is the down payment assistance funded by the lending partner?
It is. So each one of those banks that I have listed on that slide there, they have a participation in it. In total right now, we have that pool capitalized at $14 million. Now, their participations vary. I have participants that are in as little as $250,000 commitment for a 2-year period. I have funders that are committed up to $2 million over a 2-year period. In total, right now, we have $14 million in that pool. All loans that are written for this program are capitalized by our bank partners.
So I have a question, Kelly, that just popped into my head. So you have several lending partners, if you're, and they contribute at different amounts, I imagine. So then, is there any rule or tie to the lender that the homeowner that home buyer that you're working with has to utilize them for their first mortgage, or is there no tie whatsoever? There's no strings on that, or is there?
So the requirement is, so it has to be one of the lenders that are on the list. Now, that mortgage may, so I'll use an example. There's People's United Bank is a participating lender. It doesn't necessarily have to be a People's United First Mortgage as long as it's one of the banks on that list. Now, that being said, People's United in that case, if, let's say Citibank's another bank that's on that list. If Citibank writes a first mortgage and applies for and gets the down payment assistance, part of that second mortgage will be funded by People's United, even though they have nothing to do with the first mortgage. Does that answer your question?
Yes, absolutely.
Okay.
So, Bruce, were you going to say something or ask a question?
Just on the Earned Income Tax Credit, I know that there are organizations around the country that do these, and they raise a fair amount of money around these. So the service itself is provided for free. Some of the, you don't have to, you could charge fees, but if you want to be part of the VITA coalitions, it needs to be provided for free. But there's been a variety of things. So United Ways have paid for it. There's often been local politicians have been paying for it, and partly they get some credit during the outreach so that their name recognition gets in there. Sometimes lenders are interested in funding these kind of activities because it's also a way for people to open up bank accounts and things like that. I mean, there's a variety of mechanisms that what you're doing is you're bringing in a whole set of people to your program, and so it's really a cross-selling opportunity, and it's a deep service for the community. There was a lot of recognition when these EITC coalitions, the VITA coalitions, were first put together. There was a lot of recognition that this was one of the most progressive tax programs in the country and moved a tremendous amount of money into lower income working people. And the problem is that not enough people were using it, so that the whole idea is to up the game on this. And a lot of people understand the value to that. And sometimes cities are interested in investing in this because they need to increase the number of people that are accessing this and helping address low-income poverty kinds of issues.
And I just want to point out one quick thing before we move off of this conversation about the EITC program, that Sadie did pretty clearly point out that the contact person at Famicos would be really willing to talk with anybody and answer questions. So I think
the contact person is through the Cuyahoga County EITC Coalition, Enterprise Community Partners.
And you have that listed in the PowerPoint, right?
Absolutely.
Yeah. So the PowerPoint is attached to the webinar, and if you are not able to download it for any reason, just give me an email and I will get it to you. And that contact information is in there, so that if there's an organization interested in looking at it, you certainly can reach out.
This is Malia. Another question came in. For Kelly, is there a special rate on the first mortgage?
There isn't a special rate here in Connecticut. Our lenders inevitably end up using the Connecticut Housing Finance Authority first mortgages, which are discounted. The only requirement we have on the first mortgage is that it is a 30-year fixed mortgage, whether that's a portfolio product the bank keeps or if they want to work with the Housing Authority here in Connecticut and get the borrower a discounted rate. The only thing that we ask is that it's a 30-year fixed. Like I said, I would say, though, that being said, about 80% of the first mortgages we write are in conjunction through our first lender network, in conjunction with our finance authority here that does discount the rate for income-based first-time home buyers.
Thank you. And then another question that came in is, how does the HDF work with other housing agencies to offer or sell mortgages? And if so, is there a fee that the housing agency can earn?
Sure. So the way we've been able to expand in the other markets, if you've seen there, even though we have offices here in Connecticut, we're working out in New York and we've worked out in Vermont and Massachusetts. We partnered with other counseling agencies and we use them to kind of be our presence in those marketplaces, and they end up being packagers for us. So clients can go in there, we give them a list of documentation that they can collect for the borrower, and they create a lending submission package for us. We do pay them a fee for that. We strategically kind of work with people that we think, or partners that work in areas that we're really looking to have an impactful, make an impact in.
Thank you.
Well, that looks like all of our questions, Bruce.
Sounds great. Okay, thanks everybody. Let's move on quickly. A couple quick things here. First is that we have a picture's worth 1,000 words. It's still alive and well. Great picture. It's now moved on to our Facebook page, but please keep these coming. We are, we love them, and it's a good way to get your word out, but also we want to build an inventory of pictures that show our work and that we can use. All right, so don't forget about joining NHRC. We still have the credit report discount. We're still doing all our work, and you know, the membership dues are valuable to us because it's flexible money. It's not tied to any specific program. It allows us to lobby and stay independent on the work that we do. So please, if you haven't joined yet, go to our website. Actually, you can just email me and I'll send you the information. But you go to our website too, and the membership form is there. We'd love to get members in, and thanks to the many groups that renewed this month. It was a very good month for us, and we'll be, you know, please, if you haven't renewed yet, please do. All right. So on that quick note, our schedule for the rest of the year, for the rest of the summer, will be that this is the only call we're going to do in August. We're going to skip over into September. We're working a little bit about what the dates will be in September because of Labor Day and some schedule issues of the people we're talking with. But we'll do more of these kind of calls. We're also reaching out to some public officials we think might be helpful and being in touch with you all. So it should be a good fall in terms of calls as well. So with that, good point. Have a good summer, and keep an eye out on the list. Don't forget the sign-on letter, because we really need groups to be signing onto the sign-on letter to the Senate about getting the $60 million for HUD housing counseling. All right. Thanks, everybody. Have a good summer.